Hello, everyone, and thanks for joining me today. Today, I will be talking about um, the biggest, I would say, thermal field in Canada that's called Christina Lake, and really try to understand if this field is the Saudi Arabia, basically, of Canadian oil production. We're going to be going over the assets around Christina Lake region, really understanding what's going on there, the development program, the technology utilized, and really we'll try to understand the relationship between Canadian Natural Resources assets that's called Jackfish, uh, Cenovus Energy asset that's called Christina Lake, and MEG Energy Christina Lake asset, and just really kind of better understand the dynamics there and what's exactly going on. So right now we're gonna fly into the Christina Lake region and take a closer look in 1984 Christina Lake. So this is basically the wonderful Christina Lake that, as you can see here, and this is the time lapse of the development of this region. Now, most people kind of look at Christina Lake as MEG Energy and Cenovus, but I will include Jackfish in there that was bought from Devon by CNRL, and I will kind of exclude the Kirby North and South regions from Christina Lake, even though they're in close proximity. So now you can see the development here. This is 2005, bunch of holes getting poked, central process facility for Mega Energy is getting built. Companies trying to understand exactly where to go, where to drill wells. Cenovus Energy is already operating here, learning from the Foster Creek development, trying to integrate the learnings into the development of Christina Lake. And we don't see kind of much of Jackfish yet. So this will be here 2011. We see the development of Jackfish here to kind of the west side of Christina Lake Cenovus. MEG is ramping up production, developing pads on the side in 2011, and Cenovus is really ramping up operation, developing a lot of pads around the Christina Lake region. This is now 2016, right? So 2016, let's go to 2012 before. In this picture, you'd see north of the lake, you don't see Narrows Lake development. But right now, when I go to 2015, to the north of the lake, you see Narrows Lake CPF development. So the idea there was to really develop the region in the north of the side of the lake. That region belongs to Cenovus Energy. But because the Saudis basically opened the tops in 2016, right? This development of this region was postponed and basically essentially canceled as their sector went to downturn essentially until COVID, at which point oil prices epically collapsed. And now we're in 2024. We saw some recovery in oil prices. Now we're at about $70 WTI with a differential of about $14-15 in WCS. And so that really impacted that investment in the Narrows Lake region. On this side here, we can see Jackfish developing really well. Devon probably at this point thinking divesting this asset as we go into downturn of 2017. Cenovus is Christina Lake really ramping up kind of operation, trying to sustain production, utilizing their CPF as well as MEG Energy. But these companies are not getting paid at this point at all. As we go into 2019, we see sustained operations here. Narrows Lake is not being developed, even though a lot of that land basically is being kind of delineated to understand basically the pace of the oil in place, and MEG Energy kind of sustaining production, trying to be low cost of supply as well as Cenovus, and Devon kind of at this point probably throwing the towel and trying to divest basically their Jackfish asset, and at which point CNRL stepping in and buying that asset. So this is basically 2022. Now we can see we're in 2024, so there is more of an update here on the pipe, the steam pipe that was built, and the emulsion pipe that was built towards kind of the Narrows region. And what's really interesting here in 2018 and 2013 is that we saw some pad development on the west side of MEG's Christina Lake region right here. So lots of kind of development here as we look at 2017, lots of pads being built, and obviously there's realization that there's really good pay here towards Narrows region. So at the same time, MEG did develop a lot of area on the east side as well, as you can see here from 2018 from 2008 to 2016. But there was a lot of kind of interest towards that kind of northwest corner. And what's really interesting is that in 2022, right now, as we're kind of observing this, Cenovus is trying to develop Narrows Lake by connecting it to the central process facility located in Christina Lake, and by that, to expand that asset. So the technology that's being used here is called steam assisted gravity drainage, right? And what you essentially do here is that you inject steam from the central process facilities into those pads that located kind of that coupled to the central process facilities. You inject the steam, and steam dilutes the viscosity of the bitumen and then drains by gravity, right? And you have very big limitation to what that steam injection is and what oil production you can handle. And it's really a function of kind of the water that's coming back, the associated gas, and the oil that you're going to be treating. And so when we talk about comparing this field to Saudi Arabia, I will try to kind of make some comparison. So right now, this entire region, so if we take MEG Energy, Cenovus Christina Lake, and Jackfish, between all those three assets around Christina Lake. By the way, we have Kirby North and Kirby South here, which I don't include. So let's kind of just focus on those three for now, and I'll do more zoom in on each one of those assets in the future. So between all of those assets, right now the production is 475,000 barrels a day. So this is about, you know, 0.5% of kind of world's demand, and a significant portion of oil production that's coming from Canada, and most of it is being shipped to the United States. And the product that's being produced here is a heavy oil that United States only produces something like 300,000 barrels out of the 13 million barrels they produce, which is just like less than 2% of overall production. While the refineries in the United States, most of them are built for Venezuelan crude, which is heavy crude. So there is this need in the United States to import heavy crude, and they essentially export the products that they don't require as they refine those products, and ship them overseas for global growth demand, and basically kind of keep the material balance when it comes to the products they need, which a lot of those products come from Christina Lake region. So if we compare this asset to Saudi Arabia, obviously I'm not going to compare it to the most epic field in Saudi Arabia, which is called the Kawar field, but the production from there, it's about 3.8 to 4 million barrels a day, right? So here we have about 475,000 barrels a day. So it's kind of a small portion. The the thing is though is that Christina Lake does have this potential to produce that type of production if the central process facilities, so those things in the middle, those facilities were able to generate steam that in this type of volumes. So central process facility located here, and central process facility that's located here for Cenovus Christina Lake, and the central process facility that located at Jackfish. And so there's this limitation, right? Because the oil production is really a function of the gravity drainage where you inject the steam. And the key metric that these companies are looking at, it's called steam to oil ratio, SOR. And soon we will cover in detail exactly how many wells these guys have as of today. So today we're talking end of September 2024. We're going to be talking about their SORs, their operations. And the problem is that you can see Narrows Lake that wasn't really developed after 2016 Saudi basically oil glut because of the prices. The problem is that this central process facilities required significant capital expenditure, upfront investment, and then significant time that it takes to bring the oil production online. And so you basically buying you're building, let's say, a building where you don't have any renters in this building. You're just kind of building it over the next 3 years. But when you do that at low oil prices, you're basically not breaking even. So you at big risk of not cash flowing and therefore potentially going bankrupt. So we have this like natural limitation to our ability to create central process facilities, and therefore it serves as a huge bottleneck for further expansions. So even though these fields have significant amount of oil in place, just like well, not really comparable to Saudi Arabia, right? In Saudi Arabia, you can have something like, I don't know, 9 billion cubes, right? So you could have like 40 billion um, barrels in place in a field like a Gawar field, where, for example, something like MEG Energy field, you can have something like 4 billion barrels a day, right? Which is still significant amount of project area. So if we look at Christina Lake MEG Energy by itself, within this project area, you will have about 4.2, 4.3 original bitumen in place for the entire project area, out of which the cumulative recovery is close to 10%. So there is still at least 90% to be recovered with significant life reserve index, right? So which is could be 30, 40 years if you recover at the oil production rate, which is about 104,000 barrels a day as of now. But the development area they utilize is about half of that. So it's about 2.2 billion barrels, right? Um, so you do have this ability to produce at Saudi-like rates, but the issue is that you're basically a victim, in a sense, to your steam ability for steam to be generated at the central process facility. As you can see, all the pads, just like from a heart and veins, where blood is flowing, all these pads are coming from the central process facility, as you see from this timeline. And like I said, it's very expensive to build new surface process facilities, central process facilities, because it requires significant capex. And so what these companies are benefiting from right now is basically not spending that capex on building new facilities, but basically sustaining oil production and developing those pads. As you can see, change from 2017 to 2022 in MEG Energy, especially on the east side right here. So you can see this pad appearing and disappearing, where that steam from the central process facilities is being allocated from pads that are being depleted over time, right? The same thing you will see, for example, in this region, the central region for Cenovus Christina Lake, where these pads don't exist right here in 2017, right here in this area, and all of a sudden you see a pad appearing right here. So right there, you don't see any pads, and 2022 pads appear. And now you utilize that steam from the central process facility to basically fuel, or in a sense, inject that steam, that enthalpy, to reduce the viscosity of oil so it can be drained by gravity, right? So not 3 to 4 million barrels a day, just the Gawar field, right? So in Saudi, but that entire region right now, the production is 475,000 barrels a day, which, as I mentioned, fairly significant. Now, this gem here is very unique in the sense that it was acquired, right, by Canadian Natural Resources during the downturn, but it was developed with basically Devon, right? And you can see here towards 2010 or so, they're starting to poke holes here to better understand the quality of the asset, where to go, what to develop right here. And as Cenovus ramping up their production in their Christina Lake asset, um, you get that basically growth of the Jackfish asset with their pads. So this is now in 2022. You have that extension here to more to the west side, I guess, from those pads, and a little bit growth here on this pad that was developed kind of in that central area right here. Okay, so let's talk now more specific numbers about each asset, where we stand today. So as I mentioned, this is September 2024. This company is going to be reporting production and their basically financials for Q3 earnings. So right now you will know this numbers kind of before they're being public, and we can discuss kind of each asset um, to where it currently stands, right? So as we zoom in, if we go one by one, let's start from MEG Energy. So lots of interest from MEG Energy, lots of friends that own this company, and lots of friends in the sector, right? MEG Energy is this really intriguing company. You can see what's really unique about MEG Energy and well, Cenovus is that as we're going to go over the numbers, I think what's kind of in my personal mind, and as you guys know, I'm an investor in the sector as well, and used to be one of the top, I would say, innovators in the space, in the thermal space, right? Working for the majors for some time, and now currently retired. But look at kind of what's been going on here with Narrows, kind of MEG going more towards the west from 2014, kind of 2009 timeframe, and trying to really expand that region, not as much on the east side, even though they did, produce a lot of oil there. So right here, but this is really core kind of interest for Cenovus because of Narrows and MEG Energy. So let's kind of talk more specifically about MEG. Um, I actually think there's no need for MEG right now to be a standalone company. To be honest, you can see here how Cenovus it's just very organic here, the way they could integrate those CPFs, and especially with Cenovus right now, basically going to Narrows through coupling of their central process facility to develop the north side of Christina Lake. You get the central process facility here from MEG that could be utilized to to ex- to produce a lot of the barrels that could be coming from Narrows if MEG became part of Cenovus. The challenge for Cenovus is that it trades at significant, I would say, discount to. Um, MEG trades at significant discount to Cenovus on the perfluent metric, and it's much cheaper for Cenovus to develop their assets organically when it comes to kind of lowering the cost of supply. And I will explain this a little bit further. So Cenovus right now, um, and I was about to talk about the actual numbers for the asset, but I think it's really important I cover that view because you know, but this what I'm about to say, it's been valid for a very long time now as well, and but because of the downturn, Cenovus could never pull the trigger on acquiring MEG. But now that the traded premium to the company, it's a challenge for them, right? And I don't even know if it's been even considered, but you can see here geographically, like the synergies just make so much sense. Plus, they have a lot of the same investors anyway. So the investors, if one of the companies like MEG was to get acquired, the investors probably going to be happy anyway. But one thing I would say is that MEG Energy right now produces about 100 to 104,000 barrels a day, right? So the market cap for MEG is something like, if I'm in kind of like looking at my numbers here, the market cap for MEG Energy right now is okay. Let's take a look. 1 second, bear with me. Is about $6.89 billion, and their net debt is kind of getting towards the net debt target, which is about let's say $600 million, right? And so what you get here is enterprise value of about $7.5 million, right? 7.5 billion, sorry, $7.5 billion for 100 to 104,000 barrels a day. And if we do a quick calculation on the perfluent metric, so we get about 75 enterprise value divided, let's say, by 104, right? So we get about $72,000 per flowing barrel for MEG Energy value right now for this entire thing. Um, Now, if we think about Cenovus, that's getting really intriguing because Cenovus trades right now at about $43 billion, and they have about $4 billion in the book. So they're trading at about 47 billion enterprise value. But the production from Cenovus is over like 800,000 barrels a day, right? So if you think about this, uh, about 800,000, you get about 58,000 per flowing. Now, the unique thing about Cenovus is that Cenovus has a huge refinery business as well in the United States of America. And I calculated this perfluent matrix on the enterprise value without even considering the other businesses they have, which, as I mentioned, is this downstream business. So that basically is getting value of zero right now, which doesn't make any sense. And so, and to basically brownfield their assets at Christina Lake, they could develop pads for under 20,000 per flooring. And so why would you go and acquire something for 75,000, 72,000 per flooring instead of growing organically? And so that's why I think personally, I don't know, let me know in the comments what you guys think. They're not pulling the trigger. So on relative basis, Meg is kind of expensive to them. But if Meg was cheaper, then for sure it gets acquired. So in a way, there is this protective mechanism for Meg to be where it's at when it comes to its kind of value in the market. And sometimes it corrects, and sometimes it's a little bit cheaper. But uh, as far as I've been monitoring for 4 or 5 years now, obviously after the downturn, we have significant kind of changes in the balance sheets for these companies. Meg been trading in slight premium. It's almost like the market defending Meg from not getting acquired. But there could be a FOMO angle here because just to the southwest side of Cenovus Christina Lake, you have CNRL here. You have Jackfish, you have Kirby North, Kirby South, and this is could get a little bit interesting because maybe this is their Cenovus's chance to get that company and grow this asset organically to become the mini Saudi Arabia, in a sense, field of Canadian oil production. Uh, and as we see here, Narrows didn't get much life after 2015, 2016 because of the oil glut that came from Saudis and which reduced the prices of oil significantly. And it was not economic to to develop that central process facilities for Narrow to expand production further in that region here. So hopefully this kind of adds value when it comes to what I shared so far. So now let's look at the actual data, as I said, for MEG Energy specifically. It's funny, I always try to make these videos a little bit shorter, but there's just so much to talk about and so much knowledge to share is that I kind of end up talking about like random things and random thoughts I have. But so hopefully it adds value to kind of that relationship between Cenovus and MEG. But I think, in some point, Cenovus will have to take them out somehow. And I don't know what premium could be allocated to that because Cenovus trades at such discount. It's almost like not fair, right? So let's talk about the actual current current kind of numbers for MEG Energy, where they currently stand as of end of September 2024, as they look into Q3, and maybe I'll do a deeper kind of dive in for each of those assets and talk more specifically. So when it comes to MEG, I generate this data collected from the public domain and generate a lot of those inputs you're collecting. So hopefully you guys appreciate that. I don't know if it's any useful, but as of August, MEG Energy produced about 104,000 barrels per day. And the previous month production, which was July, they produced about 102,900 barrels a day. So they actually increased production by about 1%. The overall number, so in this picture, this is from 2022, but imagine we're in 2024 right now. The number of producing wells that they have in that region that I'm sharing on the screen is about 288 producers. The average production for those is about 360 barrels per day. So you have fluctuation kind of higher producing, basically well pairs and infills, and slightly lower producing. The best well though produced about 1,750 barrels per day, which is incredible, right? But you will see that Cenovus Christina Lake um, production is also kind of very similar. They produce gusher wells as well, the high performer wells, but same also applicable for Jackfish. All right, so the number of wells above the average of the 360 barrels per day is 110 and below is 178. In the top 110 wells, they produce about 77% of the oil production at Christina Lake regional project. So I will do future videos on kind of like what the technology is that they utilize. But long story short, they use SAGD, so steam assisted gravity drainage, and they basically have a lot of kind of legacy wells from legacy pads that have been developed. As you can see in this image, kind of in the time lapse, those wells, the pads, they come online at various time frames. So some of the pads, for example, like as you can see here, you have those original pads that come online and more pads. And so the newer pads, obviously, they produce more oil production as they develop those steam chambers, and the older pads they produce a little bit less. So there is this kind of change in oil production for the various pads, which makes a lot of sense, right? So they and therefore they kind of manage the steam allocation. The top 5 wells that they have, they produce about 7% of the overall oil production rate. The average injected steam for MEG Energy is about 245,400 barrels a day, and I identified 170 SAGD injectors where the oil to steam to oil ratio for this on the monthly basis right now is about 2.38, which is really healthy. So what this essentially means is that they inject about 2.358 barrels of steam to produce 1 barrel of oil. This is one of the lowest SORs in the industry. So among the 30 assets, thermal assets that I monitor across Alberta and Saskatchewan, those assets in aggregate produce about 1.7 million barrels a day, which is a lot, right? So that production that comes at 245,000 barrels a day, the steam to oil ratio for that for MEG Energy, sorry, the steam, yeah, so the steam that's being injected at 245,000 barrels per day produces about 104,000 barrels per day of oil, and the steam to oil ratio is about 2.358. And now I also kind of monitor how much like infill integration well. So infill integration, if you look at my previous video from that I talk about Green Fire, that they utilize infill and refill wells with Adam Waters wanting to acquire them. Um, they basically trying to now integrate infill and refill wells to collect the oil from the pools that adjacent to the steam chambers. And these guys are notorious, like MEG Energy, notorious for infill well integration. They have the highest infill well integration in our sector. It's close to 40% of their overall kind of producing wells, which is significant. Their water produced to steam ratio their water produced to steam ratio. So the water material balance essentially is about 1.2. So what I monitor here is that I look at basically how much steam they inject and how much water they produce to try and to better understand the material balance that's coming from their reservoirs when it comes to bitumen production and their bottom water that sits, there's like this ocean that could sit under the bitumen in regional kind of locations. So it's about 1.2. So it seems like they're able to do a good job monitoring bottom hole pressure and sustaining production in those chambers while maintaining a healthy water to steam ratio. I also monitor their water cut, so it's about 74%, which is extremely healthy and one of the top water cuts in the sector, which tells me they basically have good management of that bottom water that could be coming to their chambers. And production basically increased in about 48% of the producing wells from last month, which is good, right? So it's kind of good balance. So some production declined on some pads, but some kind of increased. So they have a good product kind of ability to sustain production. So that's kind of my update for MEG Energy. I think I'm going to be doing more of those updates. If there's interest, let me know in the comments. If I know it's a little bit more technical and there's a lot of numbers, but I think if you think about like what Peter Lynch is saying, is that you have to know what you own. In a sense, like I'm sharing what Peter Lynch would do, because if you own this company, you kind of have to know what they're producing and kind of knowing that there's kind of healthy oil production that's taking place and good economics. So now let's go to Cenovus, right? So Cenovus Energy, Christina Lake, you can see kind of the time lapse again of their development program. So Cenovus Energy production Oh, you can see kind of like I really love that how Jackfish is just like so close to them, and it kind of looks like a one giant field, isn't it? Like all of those guys, but they're three different companies: Canadian Natural, Cenovus, and MEG. So when we talk about this asset now, central process facility, all those pads. Let's see what's coming out of the central process facility when it comes to steam rates. Let's see how much oil is going back to the central process facilities and how much goes to sales, and provide that update for late September 2024. So the production in at Cenovus is essentially over double than MEG's production. Obviously, you see way more pads, right? So you see much larger amount of pads for Cenovus, and you can see much less here, and obviously more well pairs. And so that production is over double than a MEG's production, which makes sense. So now let's think about let's look at the exact numbers. So they essentially produced as of August, they produced 241,000 barrels a day. So 241,000 barrels per day. Now, if you start thinking about this, if their SOR anywhere close to SOR of MEG Energy, if SOR, let's say 2, then you start thinking by definition that the steam to oil ratio 2, right? They produce 240. Now you assume that the steam injection rate is at least 480,000 barrels a day, at least, right? So let's see what that number is. So the previous month production was 241,870 barrels a day. So the overall production for September for MEG Energy declined by 0.28%. 0.28%. So basically production been flat. And when they talk about thermal oil production in Canadian oil sands, that it's low cost of supply and basically production is sustained for a long period of time, that's precisely what they're talking about, right? Where you can just sustain production for a very long time. This provides energy security for North America. It also provides heavy oil security to United States of America that produce very little heavy oil. And Cenovus, Christina Lake is doing a really good job providing that energy. So the overall number of producing wells was 307. Just a quick reminder that the overall number of producing wells for MEG Energy was let me see here, was about 288, right? So these guys have producing numbers of 307. So that's really important to kind of consider. But MEG, they have a lot of infills, right? They have a lot of infills that they've been integrating. The average well producing at Cenovus is about 785 barrels a day. So this is like really good. This is top reservoirs. The best well produced close to 3,000 barrels a day. So 22,975 barrels per day based on what I'm seeing here. Maybe there's an error the way the data was inputted, but I don't think so. If this is real, then they have like this super gusher wells that come online, which is remarkable. So the number of wells above the average of 785 barrels per day produced is about 131, and below is about 176. So there's really good balance between kind of older wells that producing oil and newer wells. And just like I said, when it comes to the central process facility, you have well pairs, so pads that have been coupled, been developed early. So just like in this stage, we see early pads that coming online. So 2011, right? So those will be 13-year-old pads. And now you also have newer pads that came online. So if we look here, for example, if we zoom in here, so we don't see this guy in 2015, right? We don't see them, but we see them now in 2022. And so uh, this type of pads will have higher production, higher oil rates versus the older pads that came online before. All right, so let's look at some other data that's coming that I could share with the community here. So the top 130 wells that I shared that produce above the average, they produce about 72% of the production for the Christina Lake SAGD asset. And the top 5 wells produce about 5%. You may recall that the top 5 wells for MEG Energy, they produced about 7% of the overall production. So you can start understanding kind of the relative performance. Now, the average steam injected, so guess what? We talked about they produce 240,000 barrels a day in oil production. If SOR is 2, then it has to be at least 480,000 barrels a day. Well, the actual steam injection for that CPF that you see right now in the image is 503, 570, so 500,000 barrels a day, which comes from the steam comes from 199 SAGD injectors, and the SOR they have is about 2.087 for the monthly. So this is the lowest SOR in the industry. So it's 2, right? 2.087 for on the monthlies. So they basically produce 241,000 barrels per day, injecting about 503,000 barrels per day of steam, which is great, right? This is the best. And I think what's really confusing for people here is that they could say, well, you know, uh, you basically kind of need to focus on economics of your business. So the environmental performance is not maybe as important. So that's what I hear about some investors within our community. But I can tell you that if you reduce that SOR, so you reduce the energy intensity, you reduce the steam to a ratio, that also allows you to maybe allocate that steam for more oil production under lower energy intensity. So there is a huge benefit, not only from economic perspective but also environmental perspective, to reduce the steam to oil ratio. And I have huge passion towards that number to reduce the energy intensity associated with oil production in our sector. So, and I think in a way that's why I'm sharing this, because I really want to kind of further education on this topic and do something impactful like I did during my career to improve the steam to oil ratio in our operations. So, and when we think about the infill well integration, I calculated this at over 30%. So if you think about this, you have something like, from the injection point of view, you have about 200 injectors, let's say, right? And on the production side, you have about 300 producers, right? So there was a lot of kind of infill integration probably that took place, or maybe lots of redrills that, and again, the the infill integration is kind of tricky because it's hard to tell what well is kind of being redrilled, what well is still producing, and what's being used as an infill. So they have kind of this really healthy kind of balance between their steam injectors and producers. Some assets that I monitor, they have maybe like something like 40 injectors and 20 producers, like especially the assets that operate at very complex geologies. But Cenovus is doing a good job kind of um, maintaining that balance between the steam injectors and the oil producers. I also monitor the water produced to steam ratio. So the steam is being injected, and it transfers its heat to oil to be produced, and then is drained by gravity. So the water produced to steam ratio is about 1.1 for Christina Lake Cenovus, and that steam water to steam ratio was about 1.2 for MEG Christina Lake. So those numbers are very close, right? They do have like some bottom water there under the bitumen, so they do a good job, basically kind of keeping the water coming to to the wells to be produced, which is great. And the water cut is just under 70% for this asset, which is amazing, right? So um, this is really, really good. This is very good because the lower the water cut, the less emulsion they have to basically handle at surface facilities, the less water they have to handle at top. It's good for economic performance. It's good for environmental performance. You don't need to basically utilize that water, additional water, to be re-injected, even though they kind of basically recycle that water, that most of that water that's being injected, they recycle it, so you don't produce that water from the oceans that sit under the bitumen. And it's really good job by them. So yeah, great work by Cenovus here. And the other thing I look at is that what's the number of producing wells? So I see -6. So maybe they took some wells offline and maybe they were drilling new wells. So if you look at basically 300 something producers, then this number will change like under 1% on monthly basis. So the final asset I want to talk about is uh, Jackfish, right? So Jackfish is, as I said, it was developed by a super major, Devon Energy, and during the downturn, it was divested basically to um, as you can see here, what's really funny for Devon is that while, or CNRL's Jackfish asset, while Cenovus here between 2013 to 2019, I would say, were growing pads developing, you didn't really see much change basically on relative basis, obviously, for Jackfish, right? So you can see they kind of added some pads here, um, just kind of did the minimum, I guess. But CNRL right now is took over that asset, and they do a good job sustaining production and producing. So just like you guessed, it's kind of a smaller operation, right? So we have a MEG here, we have um, Cenovus in the middle here, and we have CNRL Jackfish asset here. So production is not going to be like Cenovus's production. It's not going to be 240,000 barrels a day. But the production I see from Canadian Natural Resources Jackfish SAGD's asset right now is 131,270 barrels a day. So between those three assets that we're looking now, and that's why I'm saying, look, you cannot invest in Canadian oil sands or Canadian oil production if you don't understand Christina Lake. If you don't understand what I'm showing here right now, you really don't know what you own, because this is kind of the core field for where a lot of the production coming from. And just a reminder, for in situ production for Canadian oil sands, we produce about 1.7 million barrels a day. 475,000 barrels a day from that, right? 475,000 barrels coming from that region. And as I said before, one could say, well, they could produce more, but they're limited by the CPFs. They're limited by their ability to kind of generate that steam. And the capital to do that is very expensive, which makes these assets extremely valuable, in my view, especially in the world where you have issues with energy security. So let's talk a little bit more, as I said, about Jackfish. So Jackfish in August 2024, produced 131,270 barrels a day. The month before that, it produced 124,470 barrels a day. So they basically, month over month, they improved production by about 5%. Now I'm gonna have to look at basically the averages on the monthlies, whether they were kind of in that baseline before, or maybe they had some kind of work done. But in overall, it's about 130,000 barrels a day. They have about 228 producing wells that produce 575, right? 575 barrels per day on average, right? So that's kind of what I'm seeing from the data. And the best well that produced about 22,388 barrels per day. So they have like some gusher wells as well. The number of wells above average is of that 575 barrels a day is about 85, and the number below is 143. So that ratio is a little bit worse than MEG's and Cenovus's, but that kind of makes sense because, in a sense, um, there wasn't much kind of development from like 2010 to 2020. So a lot of those pads will be kind of older pads, right? So that will be producing oil. Nevertheless, the numbers are still kind of very impressive when it comes to kind of legacy wells and what they're able to do with them. Those top 85 wells, they produce about 67% of the overall production of Jackfish. And the top 5 wells produced 8%, right? So now you can start kind of seeing the dynamic between Cenovus and the Christina Lake and MEG. The average injected steam that I calculated here is about 300,000 barrels per day. So now you start kind of thinking, okay, well, they produce 131,000 with 300,000 barrels of steam from 223 injectors. So they have about 223 injectors that we can see in this image. So between all of the pads, they have 223 injectors. Now, this image is from 2022, so maybe there was like more development in 2024. So I'm gonna have to take more look to see if we see kind of more pads in that region. All right, so for Jackfish, with overall steam to oil ratio, I get 2.293. So you start getting the picture that everything around Christina Lake has a very healthy steam to oil ratio. So those are the top steam on the monthly basis at least. Those are the top assets when it comes to the ratios for Canadian thermal production. Now I'm gonna be looking a little bit and share, just kind of add a little bit more education. What was done previously on Jackfish, just to kind of see their production growth. So just bear with me for a second. I want to better understand whether like the production declined before or they were able to sustain production. All right. So for Jackfish, yeah. So what we see in Jackfish right now is really growth in their production. So they're probably developing more pads and advancing more kind of oil production, right? Because I see Jackfish historically from March they produce about 120,000 barrels per day, but if I look at basically kind of the beginning of the year, they produced about 110, 116, right? So you can see growth, right, in Jackfish. It's one of their top assets when it comes to kind of their in situ assets. So I think it's really important to kind of mention that this picture is kind of outdated, and this kind of development program for Jackfish been really advancing recent months, where they like really grow in production for that specific asset. I'm not sure if it has something to do kind of with the strategy. We're going to have to do maybe a deeper dive to really have more updated kind of picture and really understand what pads are being developed. But hopefully it kind of gives you some context that at least on the monthlies, they're doing like a really good job increasing production on that asset. Okay, so the steam to oil ratio, like I said, it's about 2.29. Just a quick reminder, the steam to oil ratio for Cenovus Christina Lake asset was about 2.08. So, a 10% improvement, I guess, from Jackfish. And MEG's Christina Lake asset SOR was, so which is steam to oil ratio, it was 2.35 on the monthlies, right? But that SOR is lower on the cumulative basis. So it could be like 2.1, 2.2. But if we look kind of on as we add production and as they integrate like different infills or allocate steam, we see kind of more like instantaneous SOR, at least on the monthlies, not maybe dailies, on the monthlies. And so now we get kind of a better picture. But all of those SORs are under 2.3, which is remarkable. So the water produced to steam ratio Jackfish is about 1.1, and they've been doing a really good job basically sustaining production. So hopefully this was a very useful kind of update on Christina Lake and what they've been up to. And basically you let me know if you think it's kind of the Saudi Arabia version of the Canadian oil sands. Thank you so much everyone for listening. Appreciate you, and leave in the comments your comments if you have anything to share that you think about or any thoughts on the Christina Lake region. Thank you.